Hey guys, this is Vic from Grasping the Market and welcome to our morning briefing. It's Wednesday, May 15, 6:10 a.m. So let's get cracking. There is no further change on the longer time frame as we trade in the proximity of the 2800 area and the recent monthly trend line. On the weekly chart, we have a potential excess developing as we quickly return into last week's range. This, of course, needs to be confirmed, and there are still some sessions left for the week. On the daily, which of course we know is where the change first takes place, we have daily excess from Monday that has been initially confirmed, suggesting that the market could be entering a short-term balance. However, it is important to highlight that the intermediate auction still points down, and also the weak structure that we have underneath, including the incomplete auction from Monday right around 2800, is still in place. So we need to be cautious on not giving too much hype to this bounce. Zooming into the market profile, we see some further detail on how the session developed. We had change from the go as the overnight highs, which were around here, and the Monday highs were attacked without hesitation. Monday's high offered a little bit of resistance that we saw in B and C period, but eventually were taken. I think that an important point here is that C period, although it extended, struggled a bit and attempted a few times to close this double distribution. It couldn't, and the D period opened up. Now, here's the important thing. The D period did close the distribution, but it closed it to the tick, and then it rallied from there. That tells that that's a weak structure over there that was left there, and then we start getting out of range. Now, this could be a precursor factor telling you that the move was driven by short-term money, and eventually it came back and eventually it died up there. But you should have kept this in mind. It was a very important clue. Now, we have those two factors that I mentioned in the longer time frame, and yesterday we also had a weak close, because as the day developed, what we saw happening over here is that we started extending, then on G we had a little bit of a pullback, then we extended up, but then we failed to extend further from the 2853 area. Now, the market did come back, and the break was bought again from the same area, and now you have 1, 2, 3 periods low accumulating in this area. Probably you had a lot of stops underneath. So when the market, probably the inventory as well, got a little bit too long, and because there was nothing else to the upside, you could have seen a little bit of liquidation into the close. And this was a very weak close because we did dive back into Monday's range, although we managed to settle just outside. So this is a very, I wouldn't say it's a strong close. So our immediate focus for the morning is assessing that late session break that we saw in M and N periods, and understand if there was liquidation or if there is something else to the downside. Acceptance below that M low immediately brings into play that weak structure that we pointed out earlier. That will denote change and increase the odds that the move resuming to the intermediate term direction, which is down. Value within this upper distribution, basically rejecting this late break, would increase the odds that we continue upwards, considering that we have an incomplete auction to the upside. Now, if the market is getting into short-term trend, the best thing is to wait, settle, do not rush. We're right in the middle of this range that we saw yesterday, so there will be a lot of chop if we open up in this area. So it's better to wait for the market to settle a bit, have some clear direction before getting involved. Remember, anything can happen. Odds are just odds. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Any opinions, news, research, analysis, prices, or other information offered by Grasping the Market is provided as general market commentary and does not constitute or replace investment advice. Grasping the Market accepts no liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from the use or reliance on such information.